Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Before we get started, today's video is going to be a shortened, condensed version of what we usually do in our SPX videos. So in this particular video, we're not going to go over all the different aspects of the indicator. We're mainly just going to go over today's trades for this particular session. If you are not familiar with the SPX Daily Key Levels indicator, then look in the description of the video underneath the video on YouTube, and you will see in the description these particular links that go into more details about how the indicator works and the trading strategy. So there's a video overview as well as additional resources with a Google Drive link for descriptions, links to other videos on different topics about the SPX indicator, and then there's also links to longer that are hour to an hour and a half long SPX trading videos that will go into a lot more detail about the indicator and the daily key levels strategy. If you click on this Google Drive link, we'll show you what screen that takes you to. That'll take you to this particular document, which will have links to other specific topics that are covered about certain aspects of utilizing the indicator. Thank you. Hello, in today's video we'll be taking a look at the December 17th, 2025 trading session for the SPX CBOE index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator, specifically the V2.0 version of this indicator, which was released about 6 weeks ago. Okay, so today's video is going to be a condensed video. It's going to be a lot shorter than our typical videos, so we're not going to go into all the details about this particular indicator and all the details about the strategy. Again, as we pointed out in the preview to this video, if you would go to the description of the video underneath the YouTube video, you will see links to other various videos, which I'll show you again now before we get started. So here are other SPX trading videos that you can look at. Video overview of the SPX Daily Key Levels indicator V2.0. Click on this link for a descriptions link to other videos mentioned on different topics about the indicator, which is this link here, which will take you to this Google Drive document here, which has different videos about different topics about the indicator and specific details about certain points of using the indicator. And then these are links to longer SPX trading videos that are about an hour to hour and a half long, which go into more detail about the indicator, how it works, what the levels, different levels mean, and the daily key levels trading strategy utilizing the indicator right here. Okay, so back to today's session. We have the 9:30 a.m. opening candle right here, which is marked off here. This is the 9:30 a.m. opening candle. As you can see, it opens below, but most importantly, it closes below the bull bear key price level, so that is your bearish entry signal on the 9:30 a.m. opening candle utilizing this indicator. As noted here, it is still within the acceptable range. The acceptable range is one of those videos that's available on the Google Drive link. There's also an accompanying PDF document that goes along with that video, where we talk about the acceptable range of 9:30 a.m. opening candles closing above or below the bull bear key price level, and that acceptable range also applies to taking trades off of any of the other main key levels, specifically the R1 through R6 levels, or taking trades off of the S1 through S6 levels. As with this indicator, you can take trades off of any of the main key levels, which are the BBKPL, which is the bull bear key price level, as well as the main R1 through R6 or main S1 through S6 levels. The midpoint levels and QL levels have different purposes and are not for taking trades off of, which is explained in the other longer videos which go into more detail. Okay, so on this particular trade here, our tight stop loss on this trade is going to be the QL above the bull bear KPL, or the standard stop loss on the bearish trade from the BBKPL level is going to be the first midpoint above. With this particular strategy, it is preferred to use the standard stop loss level. However, whether you use the standard or tight stop loss is up to each individual trader and their risk profile. Okay, as far as 0DTE options, you can utilize either 0DTE options or 1DTE options with this indicator. Again, that is another video found on the Google Drive link in which we go over the pros and cons of utilizing either 0DTE or 1DTE for day trading utilizing the strategy and this indicator. So I would invite you to look at that particular video, which goes over the pros and cons of that, and also has links to other videos which we go over showing how each of those particular 0DTE and 1DTEs work out in a particular session, and compare and contrast those. There are 3 different option strikes that you can use on any bullish or bearish trade off of any of the main levels. In this particular case, the main level we're taking the trade off of is the SPX bull bear key price level. The standard play utilizing this strategy is going to be the option strike which is closest to the level that you're taking the trade off of. In this case, for this particular session, the bull bear KPL is 68.1540, so that is going to be the SPX 68.15 strike. And since this is a bearish play, we're utilizing the 68.15 put. We're waiting for the close of the candle to make sure that we are seeing what the bias is going to be on this 9:30 a.m. opening candle. As I said at the beginning of the video, it does close. Most importantly is where it is closing, not particularly where it is intra-candle, but where exactly it is closing below or above the bull bear key price level. In this case, it does close below. It is within the acceptable range, so that is a bearish entry signal. The ask price on the 9:30 a.m. Candle close, again, we're on a 2-minute chart. As you see in our other SPX trading session videos, the recommended time frame, a chart time frame for utilizing this strategy with this indicator is the 1-minute to 5-minute chart time frame, with the 2-minute chart time frame being the most consistent performer within the 1-minute to 5-minute, and that is the chart time frame that we show in all of our trading videos. The ask price on the 9:30 a.m. candle close, which closes at 9:32 a.m., since this is a 2-minute chart, is $19.80. Here are the entries here. These are the ask prices based on the close. Here, as you can see, $19.80 for the 68.15. There are always, as I said, 3 different strikes you can use on any bullish or bearish trade. So on this particular trade, since this is from the bull bear KPL, we're looking below since this is a bearish trade. And our first out of the money option is going to be the first midpoint below the level we're taking the bearish trade from. In this case, the mid BBKPLS1, 68.0734. The closest strike to that is going to be the 68.05 strike, so that would be the 68.05 put. The ask price on the candle close, $15.30. The furthest out of the money strike you can consider on this trade, this bearish trade from the bull bear KPL, is going to be the full level below the level you're taking the trade from. We're looking below again since this is a bearish trade. That is going to be the S1 level, 67.9928, so that is going to be the 6800 0DTE put option. The ask price on the 9:30 a.m. candle close is $13.40. There are two different types of trades that you can take using this strategy as far as exits. One is a scalp only trade, and the other is what we deem a regular trade. Scalp only trade, you're looking for a one level move in your favor, and then you're doing a 100% exit of all option contracts. So if you're just trading one or two, or you have 5 puts or 10 puts, it doesn't matter how many options that you have. If you're doing a scalp only, then you are exiting the trade after it has reached a one level move in your favor. How that is determined is that you take the level that you are taking the trade from, in this case the bull bear KPL, the direction you're taking the trade, which is going to be down since this is a bearish trade, and we look one full level down, so that means when it hits S1, then we are exiting the trade if we are doing a scalp only trade. And at 9:36 a.m. it hits the S1 level, so that would be your exit for a scalp only. That is the one level move in your favor. Now here we have the bid prices on the candle close, and as you can see here, the 68.15 is 26.90. That's a profit of 7.10 per contract. The 68.05 bid on the candle close, 21.40. That's a profit of 610 per contract. The 6800 is $19. That's a profit of $560 per contract. Now with a regular trade with this strategy, with this indicator, you are looking for a minimum 1.5 level move excuse me, in your favor. 1.5 level move, it's the same exact process. We take the level we're taking the trade from, in this case a bearish trade from this level, the bull bear KPL. We look one level down, then we look the next half level down, that is the mid S1, S2, 67.91.22. So when it hits the 1.5 level move in our favor, if we did not get out on a scalp and we're instead doing a regular trade, then that is your trigger threshold, minimum threshold for the regular trade. That's at 9:42 a.m. Here we have the bid prices for the 9:42 a.m. candle, and as you can see here, 68.15 is $30.80, profit of $1,100 per contract. 68.05, 24.80, profit $950 per contract, and the 6800 furthest out of the money, 22.20, profit $880 per contract. With a regular trade, you have several options with a regular trade. One is that you can adjust your stop loss on your regular trade to break even or break even plus a 10 to 15% profit buffer. The other option is just exiting your trade like you did with the scalp only and exiting all of your contracts. So you can either adjust your stop loss to break even. Break even would be what you paid for the contract. So where we're starting off utilizing levels for our entry stop losses, we are instead now switching to a price-based stop loss when it hits our regular trade minimum threshold, and then we are using our price that we paid for a break even or adding to this price if we're adding a profit buffer of 10 to 15%, the initial profit buffer when it hits this level. The third option that you have is going to apply if you are trading multiple contracts, meaning 3 or more contracts, and that would be scaling out. So scaling out would mean selling and exiting at the profit here 70 to 90% of your contracts. So for example, if you had 5 contracts you were trading and you sold 4 of them here at these prices, then you would have 1 contract remaining. So you would exit 4 of them, that would be 80%. And then on the remaining 1 contract, you could move that to break even or break even plus a 10 to 15% profit buffer. Now with a regular trade, you are either, if you're not exiting 100%, then what you're looking for in succeeding moves is that at every level move in your favor thereafter that occurs after the 1.5 level move threshold, you are looking to then have the same decisions to make those same three decisions as it hits each succeeding level in your favor after the 1.5 level move in your favor being the minimum threshold. So here we have the 9:42 a.m. So the next level down is the S2. That is a 2-level minimum ideal move for a regular trade, and that is at 10:34 a.m. here. And then we have the bid prices for the candle closes here for that candle close. As you can see here, the 68.15 is now 36.40. Profit $1,660 per contract. The 68.05 is 29.20. $1,390 per contract. 6,800, 25.80. Profit $1,240 per contract. The difference between the minimum ideal move and the minimum required move, the minimum required move is the minimum threshold in order to trigger the regular trade options. What we mean by minimum ideal move is that in a low to moderate or say normal volatility situation, which is about 80% of most sessions that you will see will fall into the low to moderate or normal volatility, a 2-level move from the level that you're taking the trade from. What that means is that if the trade is from the bull bear key price level, then a 2-level move is here down to S2. If we were instead taking a bullish trade, if we had a bullish opportunity, in other words, if we started having consolidation and then closing candles above S2 and it looked like a reversal and we were taking a bullish trade off of S2, then a 2-level move back in the other direction up would be the bull bear key price level, and then a scalp on a 1-level move would be the S1, and then a 1.5 level move would be S2 to the 1.5 level move here, mid BKP LS1. And it works the same off of the other levels as well. If you were taking a bearish trade, if we had activity up here and then we had a bearish reversal off of R2, off of bullish activity coming up here, consolidating and then reversing off of R2, then a 2-level move from that would be back down to the bull bear key price level. However, in higher volatility environments, then you're looking more for a 3-level move or above. And in extreme volatility environments, then you're looking more for a 4 to 6 or even beyond 6-level moves in extreme level volatility, which would be categorized by, say, on some FOMC interest rate days, you'll see those kind of moves, or other big news environments, or when we have other types of events such as the COVID pandemic or the 2007-2008 market crash, in which we will have extended weeks sometimes or even months of extreme to high volatility. So the 2-level move is more for the low to moderate or normal type of volatility environment. Okay, so also you have here at 10:44 a.m. as you can see, we had a brief retrace here. It did not close back above, and then we resumed the downtrend here, and at 10:44 a.m. it hits the mid S2 S3, so that's now a 2.5 level extended move for a regular trade. In the 2.5 level move, again, we take the level we're taking the trade from, bull bear KPL, bearish trade, we're looking down. So we have 1 level, 1.5 levels, 2 levels, now 2.5 levels. The 68.15 put on the candle close, on the bid on the candle close, 51.60, now $3,180 profit per option. The 68.05 is now 43.10, profit $2,780 per option. 6800 put now to 39.20, so that is $2,580 profit per option. As you can see here, we had a brief attempt here to try to close back above this midpoint, but again, we had a move down. As you can see here, we have the YDL level, which, as we explained in our longer videos, what all these levels are here. You have the pre-market high, yesterday's daily high, which is the previous session's RT8 session high, the pre-market low, YDC, yesterday's daily close, the previous session's RT8 session close, and the YDL, yesterday's daily low, the previous RT8 session low. Oftentimes you'll see when the price gets very near here, it is seeking to at least test the YDL, so that's something to be aware of with this indicator. And also when you see any of these levels, the PMH, the PML, the YDH, YDC, or YDL, if they occur after the 1.5 level move has happened in your favor and you are in a regular trade, then if any of these levels on a bullish or bearish trade occur after the 1.5 level move in your favor and the direction of the trade that you're taking, those are additional waypoints for decision making, just like the levels and the midpoint levels. So here at 10:52 a.m. you would have another decision to make here. So here you have the extended move for the YDL hit here, 10:52 a.m. Bid prices on candle close, they're over here, 10:52 a.m. $60.30 on the 68.15. The profit is now $4,050 per option. The 51.80, the 68.05 is now 51.80. It's a profit of $3,650 per option. The 6800 put now 47.50 on the bid on the candle close, now profit $3,410. So as you can see here, utilizing the out of the money options here, you started out only paying $13.40 as opposed to $19.80 for the at the money. And here you're at $47.50. So there are pros and cons of using either the at the money or the out of the money. That's up to each individual trader. If you do get an extended move like this, then the profit percentages on the out of the monies can become quite significant. Okay, so here, as you can see, we had a move and a forceful move down to YDL. We did not have just a touch and then a sideways move and perhaps a reversal back up. As you will see on some days, we did have a pretty forceful close through. And what happened is we went down to the very next level here before we had a brief relief bounce here. And at 10:54 a.m. it hits the S3 level, so that is now a 3-level move in your favor from the start of the trade at the bull bear KPL level. And here we have the 10:54 a.m. data boxes here with the bid prices on the candle close of this 10:54 a.m. candle. 68.15 put, now 62.70, profit $4,290 per option. 68.05, 53.40, profit $3,810 per option, and the 6800, 49.30, profit $3,590 per option. Okay, so we had sort of a sideways. We tested the YDL level here, moved back down, hit the R3 again, wicked through it, then went back up to YDL, failed again. Failed meaning we don't have really any successive candle closes above, and we're getting the move back down to S3. And so this is still fairly bearish price action here. And so here, as you can see, we went back up and could even touch the YDL here, and then we're falling back off. And then here at the 1:40 p.m. candle, we finally hit the mid S3, S4 level, and that is now a 3.5 level extended move for the regular trade. And the bid prices on the candle close are for the 68.15. Those are up here. There wasn't really enough room to put them down here. 79.40 on the 68.15 on the bid. $5,960 profit on the at the money 68.15. Again, we started off at 19.80 and it's now 79.40. 68.05, 69.40, profit $5,410 per option. 6,800 now all the way up to 64.80, profit $5,140 per option. Now, as you can see here, we're getting into the 1:30 to 2 p.m. range here. We're moving pretty much sideways here. There really is no bounce back up. We're simply just moving sideways and working time off the clock. Now, if you've seen some of our other videos, we do have some videos that talk about the 2 p.m. to 4 p.m. Window, which is for lotto option plays, which starts at 2 p.m. So here we've been in this trade. So one thing to keep in mind is that we've been in this trade since 9:30. So at 1:30 p.m. here, where it is hitting the mid S3, S4, we've been in this trade for 4 hours now. So even though there is a possibility that we could continue to move down, and in fact at the end of the day towards the close we almost got to S4, it is something that you do need to be cognizant of, especially when you're using 0 DTE instead of 1 DTE, is that now if you do start getting a retrace move against you, then these options are going to start evaporating your profit pretty rapidly, because we are rapidly losing the time value, because these 0 DTEs will expire at 4 p.m. versus the 1 DTEs, which expire the following day at 4 p.m. So in this particular case, when you're utilizing 0 DTEs, you need to be cognizant of the fact that if you've gotten a well-extended move in your favor and you still have contracts in this trade at this time, that you need to be cognizant of the fact that you either need to really tighten up your stop loss and add a significant profit buffer, so that if it does begin to go up, you're just going to be taken out and you're going to exit and still keep your high profits intact. And because the last thing you want to have happen here is that you've gotten all this profit here, and then all of a sudden at the end of the day it starts evaporating, because now we start to get a move back up. There are days which you will get a move like this, and then it will make a significant move back up to try to challenge the bull bear key price level again towards the end of the day. That did not happen in this session. In this particular session, if you had held on till the end of the day, which is not really the most prudent thing to do, however some people like to do that with SPX options, because unlike SPY options, with SPX options, if you're in the money at the end of the day, then you get paid cash as far as you're in the money, the difference between the strike price and the closing price of SPX. So there's no exercise or anything as far as like you would have with SPY, where you could actually get shares. With SPX, they're all cash based, so if you do hold on to the end of the day, that's not really recommended. But you know, if you did only have one option left, let's say you started out with 10 options, you only had one left, you had taken profits all along the way, and you just had one remaining, you know, then maybe, you know, you could hold on to the end of the day to see what happens with that one if you tighten up your stop loss. However, just be cognizant of the fact that when you start getting into this, especially 2 p.m. and after, you really have to be cognizant of the fact that if you've gotten a fairly good profit, it is a good idea in most cases to go ahead and just close out the remainder of the contracts. That doesn't mean that you can't look for a lotto play at the end of the day. And if you look at our other longer SPX videos, some of those videos, there may be like 5 or 6 out of the 30 or so that we have that go into the lotto strategy. That's also part of the daily key level strategy. That's basically where you're taking 10% max of your session profits. So let's say you had closed out here on the S3 and you had $4,290 in profit per option. Let's just say you were trading one option, so you would take a max of up to 10%, which would be roughly $430, and that would be available for doing a lotto option play. So that way, if you do a lotto option play later on during the 2 p.m., basically the lotto option window runs from 2 p.m. to about 3:40, 3:45 p.m. The session closes at 4. So any lotto option plays you want to have secured by about 3:45 p.m. or so. but as far as starting to look for them, it starts at about 2 p.m. And if you're only taking 10% of your current session profits for a possible lotto option play, that doesn't mean you have to take one, but if you see a good opportunity, whether that opportunity is a directional play, a long directional play, meaning either just buying a put for a bearish lotto option or a call for a bullish lotto option, or if you're doing a non-directional, which would either be buying a long straddle, which would be buying a put and a call at the same price, or if you're doing a strangle, which is an out of the money call and an out of the money put, regardless of whether which one of those strategies you're employing, you don't want to put at risk any more than 10% of the then current session profits. So that way, if your lotto option doesn't work out and you lose all the money in the lotto option, then you still have 90% of your profits still intact. Okay, so we went over these again. 68.15, 79.40, profit 5,960, 68.05, 69.40, profit 5,410, 6,800, 64.80, profit $5,140. Okay, so that's going to wrap up this video. As I said before, please take a look at these other videos here. They're in the description of this video. A video overview of the indicator. Click on this link for descriptions, links to other videos mentioned, which those are here. Here's the one about the opening candle trades to avoid on the 9:30 a.m. opening candle, and also on how to recognize which ones to avoid. And it also goes into the acceptable range, which we talked about, which applies to taking trades off of any of the main key levels, not just trades off the BBKPL level. So that is this document here. Here's the video on it. This is the accompanying PDF document. Here's one about the process of how to determine the two out-of-the-money strikes. You can consider utilizing the standard play versus using the standard play at-the-money option strike. Here is how to place stop losses on options on the thinkorswim platform based on the underlying price. So that would be your entry stop losses based on a level. So there's two different videos for that. This is again another video about the process of determining the out of the money strikes versus at the money, and there's also three videos where we go into more detail about that in a particular session. Here's the one about the pros and cons of using 0DTE versus 1DTE. This video here discusses entering bullish or bearish trades off of any of the main R and main S levels. So that would be entering trades on bullish or bearish trades off of the other main levels besides the bull bear KPL. And also the different types of trade entries, the standard trade entry versus the conservative trade entry. And this particular video shows several examples of both bullish and bearish standard trade entries and also conservative trade entries, and how to recognize the differences between the two. This video discusses how to set up and use the historical bull bear key price level and historical main R and S levels feature of the day trading GPS Daily Key Levels V2.0 indicator. The historical levels can be good for going back and studying how SPX reacts at certain levels in recent sessions, and it can also give you a good idea of the types of moves that it's making off of levels once it gets to, say, R1, R2, R3, or S2, S3, S1, and then the reactions off of those. So that can be a very useful feature to study as well. This video discusses all the indicator features and inputs in the user control panel. This video goes over the default look on the startup of the indicator and changing the chart display to your preference. And again, this is the same video here about the video overview of the indicator. And then these links here are to the longer SPX trading videos that go into more detail about the indicator, what all the different levels mean, and more details about the daily key levels trading strategy. Okay, so that's going to wrap it up for this particular video. Thank you for taking the time today to watch the video. As mentioned in the preview, if for you taking your time to watch the video today, you can request a discount promo code if you have an interest in purchasing the video. And you can send us an email at daytradinggps@gmail.com to request a discount promo code for the SPX Daily Key Levels indicator. All of our indicators are sold currently on a one payment for lifetime access basis. That means you make one payment and you have lifetime access to the indicator. That also means that you will receive any additional versions of the indicator that come out in the future at no additional charge when we come out with new versions that have substantial new features, which we are coming out with a V3.0 version of this indicator sometime shortly after the first of the year, probably sometime in mid-January or so. We will be coming out with the V3.0. At that time, when that happens, the price of the indicator will be going up substantially. So now is a good time to purchase the indicator, as you will get it at the current price level and also be able to apply the promo code. And then when the V3.0 version is released, you will get that at no additional charge versus other people who wait will be paying substantially more for the indicator at that time. Okay, thank you again for watching the video. If you did like the video, please hit the like button as it helps us with the YouTube algorithm. And if you'd like to subscribe and be notified, please subscribe to our YouTube channel and you'll be notified of when we post any videos on any different trading topics or any other SPX trading indicator videos or any other videos on our other daily key levels indicators for stocks, Forex, crypto, and futures, and also the NASDAQ NDX indicator. Alright, thank you again for watching this video. I hope you have a Merry Christmas and Happy Holidays and a great New Year.